Hey Tyson, I'm really excited about our show today. Uh, want to invite those of you who are listening to really just enjoy this topic today. It's a topic that it's probably one of our most asked about topics. We talk a lot about taxes. We talk a lot about the problems. And Tyson, there's definitely lots of problems. We're going to recap those today when it comes to taxes. But you know, one thing that people don't realize is that you have more control over how much you pay in taxes in retirement than any other time of your life. And so this is kind of a deep dive in that. What are some of the things that you can consider? What are some of the things that you can think about when it comes to taxes, right?
Yeah, so many people, they know exactly how much money they have sitting in their 401k or their IRA. And yet, when we ask them, do you have any idea how much you're going to be paying in taxes to the tax man? They kind of get this blank look on their face. And it can eat up a huge portion of your income if you don't have a plan in place, right? It's one of those things that um, we can be the wake up call for a lot of people to help them to understand how big a role taxes can play. In fact, people have more control over what they pay in taxes as they near retirement than any other time in their life. And so we definitely want to share some of these strategies and ways to help people to keep more of that hard-earned money that they've worked so hard to put in that 401k, keep it in their pocket.
Well, let's frame that a little bit and let's talk about, you know, here's some of the common scenarios that we see when families and individuals come in and visit with us. They've spent really decades saving in their IRAs and their 401ks. And most of it's inside your 401k because I mean, think about it. You went into a meeting one day at work and they're like, "Hey, we've got good news. We're going to get rid of your pension and we're going to give you this new thing that you can control all your investments. It's called a 401k." Um, if you don't know, that was not a good day at work because they got rid of the pension and they started with a match on your 401k and they made it sound really good. I mean, it's, hey, you're going to put this money in, it's going to go in tax free, it's going to grow in tax deferred. You're going to come to not like the word tax deferred because really what it means is you're just kicking the can down the road. And then, hey, not a big deal. You're going to pay taxes on it when you retire, when your income's gone down, and that's going to be good news. That was the myth
Yeah.
that you heard. That's what you heard at work. And now you look at the scenario, the pension's gone for the vast majority of Americans, unless you work for the federal government or the state government. Most private pensions don't exist anymore. And so, Tyson, now it comes time to withdraw your money. What's that going to do? What's that going to do with Social Security?
Well, the problem with Social Security is so many people don't realize that up to 85% of their Social Security benefits could end up being taxed. Now, that doesn't mean that 85% of your benefits go away. It just means that most of your benefit gets taxed. And so many people are like, what are you talking about? I had no clue that Social Security could get taxed on their income, and this becomes a huge burden if they don't understand it right. And if they don't take these strategies seriously, taxes can end up being one of the biggest expenses that you have all through your retirement. And we just don't want that to happen. And we've talked about taxes in general before, but those were just the basics. Today, we're going to take a deeper dive on how this works and some of the strategies that we employ.
Well, Tyson, let's use numbers because numbers always help understand the size and scope of the problem. So, in our book, The Boss Retirement Blueprint, Your Guide to a Secure and Independent Retirement, we have Bob and Carol, who are the avatar prospect that comes in. What I mean by that is it's just a compilation of thousands and thousands of cases that we've seen over and over again. And you all have the same problem. You all have the same problem. Here's the problem: they were fortunate enough to be able to save over $1 million in their 401k and IRA. In fact, 1,074,000, so almost 1.1 million that they've saved inside their 401ks and IRAs. What they don't understand is how much they're going to pay in taxes. So, Tyson, if this account grows by just 5%, there's four areas that they're going to hit. Now, I'm going to tell you three because I don't want you to be depressed Okay, the fourth one's even worse, and it's what you just talked about, Tyson, which is Social Security. But think about this for a second. Total taxes paid on required minimum distributions. When you get to age 73 now, you have to take out a required minimum distribution. They owe in taxes, this is not their withdrawals. If this account grows by 5% from the time that they retire, if we measure from 70 to 90, they're going to pay $437,601 in taxes. Remember, this is $1 million IRA and 401k. Then they take the money out. They want to reinvest that, right? They're going to owe $124,898. That's money they put in their brokerage account, get a 1099 and have to pay taxes on it.
Yep.
Then they die and they owe $390,486 for a grand total on that $1,074,000 IRA. They owe $952,985. Now, I wish that was the end. I said those were the three big tax impact areas. The fourth one is taxes that they pay on Social Security. I'm going to tell you, but I'm not going to show you. It's $143,000. So in other words, over $1 million in taxes on $1 million IRA and 401k. Now it's growing as they go through time, but that's the impact. 952,000. Most people are like, there is no way. I can't imagine how that is. Well, we just did the math for you, so you can see that. Tyson, there's got to be some good news in this story. What's the good news? How do we help Bob and Carol minimize it?
The good news is we've helped thousands of people to minimize their taxes as it relates to any of those four areas that you talked about. And, we want to, in today's show, we want to talk about the updating of the tax brackets, deductions you can take for 2025, some advanced Roth conversion strategies, how life insurance could play a role in this, and even some potential proposals that could impact this further. We're going to talk about all of this because we believe that giving good information to good people, together we can make great decisions, especially around taxes. And it's the biggest needle mover of any other place on the B.O.S. retirement blueprint is taxes.
Okay, so before we go into those strategies, I think it's important. Let's just look at this. Instead of a $952,000 tax bill, not counting Social Security, we were able to drop that tax bill down to $311,000. So that's a difference of $641,000. I don't know about you, Tyson, but I think there's a lot of things that you and I could figure out of what to do with $641,282. And I know those of you who are listening, you could definitely figure out a better way to spend that than Uncle Sam.
Well, and that's why I brought those strategies up, is because it's not just the example of Bob and Carol that makes a difference. It's taking that example and putting it into your situation, taking Bob and Carol's situation and saying, how does this apply to me? And what is going to be the best news for me? Now, keep in mind, all of these strategies we're talking about today, every situation is unique. As I just mentioned, you're going to want to consult with your own financial advisor or tax professional before you make these decisions. We are not CPAs. We do have a CPA on our staff. We have somebody who's has a master's in tax. We know how to talk about these things, but you want to have this backed up by your own advisory team as well. And Ryan, let's start by discussing these updated tax brackets, these standard deductions. What should retirees know around this?
Well, you have to go back to 2017 because the 2017 Tax Cuts and Job Act that was put in by President Trump, it's one of the most misunderstood things that happened for retirees out there. Because, President Trump talked about it as a tax cut for retirees. Or tax cut for workers. Really what it was is a major win for retirees because he changed the percentages a little bit, but more importantly, he expanded what the tax brackets look like. I mean, big expansions. Let me translate what that means for you. You could do Roth conversions. You could do Roth conversions where you could pay taxes while taxes are at all-time lows. And then you could get that into a Roth where the growth now is tax-free and the distributions are tax-free. And in most cases, you're not going to have a required minimum distribution, right? So that was a huge win for retirees. Now, They're talking about it right now. Congress has a bill that they're working on right now to extend that. But let's just say that it doesn't get extended.
Mm-hmm.
Well, from 2017 until 2025, all the way through 2025. So this is something that you may want to take advantage of immediately if they don't get extended. You were able to use these expanded tax brackets to be able to convert money over into a Roth IRA, which literally is one of the ways that you can save tens of thousands, if not hundreds of thousands of dollars in taxes in retirement. So that that was a big deal is when those brackets were expanded. And understanding these brackets, it's like it's like when you're in school. Remember when your teacher used to tell you, okay, this would be really, really important to study for the test. This is one of those areas in retirement planning, understanding the tax brackets.
Mm-hmm.
You can go Google it right now. Go Google it and see what the tax brackets are. And let's say you're making $100,000 a year and you look at what the bracket is. And we love the 24% bracket, Tyson, because for an extra 2% from 22 to 24, you can get a lot of money over into Roth conversion. And that could be something that could literally save you down the road hundreds of thousands of dollars, just like we showed about the example in Bob and Carol.
Well, and let's really hope that Congress extends those uh, that time frame past 2025 because we like to do something that we call a Roth conversion ladder if we can if we have the time frame to do it in. So what does that mean? It means that we take a look at that bracket you just mentioned going from 22 to 24, and there's a lot wider gap of how much that you could take from your 401k and convert it over to a Roth, but we don't necessarily want to do that all in one year. You mentioned that if it doesn't pass, that the end of 2025 would be the last time that we could do this, which would still be amazing. It would still really change the tax play for so many Americans, so many of you listening. But if we can do this Roth conversion ladder, it's going to really help you to get cozy up right up to the bracket, how much you can pull out, how much you can save in a given year, and then do that over multiple years. That's the beautiful thing about this is you convert portions of your IRA or your 401k each year to spread out that tax burden while staying in lower brackets during the time frame that you want to do this in, so that you can get to retirement. And the most beautiful thing would be, hey, we've already paid all your taxes. You don't ever have to worry about required minimum distributions, which we'll talk about here in a second. You don't have to worry about paying taxes in the future because it's all in a Roth. And so there's a lot of different pieces. Timing this income strategically could be a big deal for you.
I'm looking at the 2025 tax brackets, and these adjust a little bit every year, but the 24% tax bracket allows you to go up to 394,600 for a married filing jointly tax return. So let's say you're making $100,000 a year and you've got $1 million in a traditional 401k or IRA.
Yep.
Well, taxes are on sale right now. That's the first thing you need to understand, because I mean, you go back into the 80s and the highest federal tax bracket was 70%, 70. I mean, think about that. It's like, why do you want to make any more money? 70%. So if you compare 24% to 70%, that's a big deal. Well, if you're making $100,000 a year, you could convert up to 294,000. So in other words, just simple here, you could convert another $294,000. So your $100,000 income plus 294,000, you could pay 24% in federal taxes on that, convert it over, get it into a Roth, which now you're in a tax-free environment forever. Now, some people are like, well, I don't want to pay 24%. Well, do you want to pay 70? I mean, we have no idea. When you look at the federal tax, when you look at the national debt, you look at Medicare, which is almost double the problems of Social Security. You look at all the different things that are going on. Neither side of the aisle can balance what's happening. So they just keep adding more and more onto this. Our feeling is taxes are on sale right now and they're going to go up. Now, are they going to go to 70%? I can't see that. I can't see it going to 70%. But this is one of those areas, before I think that number was 181,000. So instead of 394,000, it was 181,000 in that bracket. And so President Trump pushed that. This is why this is such a huge gift for retirees, because before you'd have only been able to get out 81,000 if you're making 100,000. Now going all the way to 394,000, you can get 294,000 out, pay taxes at 24%, which is a bargain historically. Get it into a tax-free environment. Now you don't have to worry about a lot of different things that are going on out there. That's something that I'd definitely be thinking about.
Now, one of the things to warn people about is you were giving people numbers based off of up to certain amounts. We do all these calculations. It's more complicated than just saying, hey, here's what your 24% tax bracket is. It depends on how much you made. It depends on how much you put into your IRA and 401k for the year. It depends on how much you donated to charity. It depends on a lot of factors. It depends on when you're taking Medicare, all of these different things. The beautiful thing is we can do this exactly for you. We don't have to just give you round numbers. We can help you to do this exactly. And one of the things as well that you ought to be considering, if you haven't done it already, is to most employers now are required to have a Roth 401k option. If you're not contributing at least a portion of your IRA or your 401k every year, your contributions into that Roth 401k, even though you do pay taxes up front, you'll never pay taxes on it again. You ought to be doing some of that as well to be able to ensure that you're able to save as much in taxes as possible. And then I want to talk for just a second about the potential of using life insurance. Now, this doesn't work for everybody. You have to have the right health, you have to have the right scenario, but it's like having a Roth IRA or a Roth 401k on steroids, meaning that you don't have to worry about what tax brackets look like. You don't have to worry about conversions. If you want to start putting money aside and moving it over to a life insurance policy, that could be an amazing strategy as well, especially for high income earners where they get phased out of a Roth, what we sometimes call a mega backdoor Roth. It gives you the opportunity to do some of these same strategies, but put it into a life insurance policy. And the way that you build the life insurance policy is you minimize the death benefit as much as possible while still contributing as much of your money into the life insurance policy as possible, which gives you tax-free growth and tax-free income when you get to the point where you want to start pulling that money out. Again, this has to be highly customized, but especially for high income earners, this can be an amazing strategy that so many people across the country utilize each and every year.
Well, and Tyson, Roth conversion, life insurance, what's the difference? Well, if we just simplify it, imagine, I mean, on that scenario we just gave you where you converted, 294,000 out of your Roth IRA. If we take 294 and we times that by 24%, you've got $70,000 in taxes that you're paying. Now, that stinks. I mean, that's a big dollar amount for a lot of our families that we help with this. They're like, that's the biggest tax check I've ever written. And it probably will be the biggest tax check. But imagine with life insurance being able to recapture through death benefit when you eventually die for your family or your favorite charity. Imagine being able to get that back. If you just do a straight Roth conversion, that money's gone. And now you've taken that money down and
Yep.
you just have to grow it from there. Well, with life insurance, what it does is it gives you the additional benefit to potentially make all of that tax money back that you paid. Now that's, if we go back to the beginning of the podcast, when we think about Bob and Carol, where they're basically paying $1 million in tax, right? They're paying $1 million in tax on their IRAs and 401ks. Now imagine if you have $1 million death benefit that goes along with the strategy that you're doing, and that $1 million comes back and replenishes all the taxes that you paid. Now that's another powerful strategy. Save hundreds of thousands of dollars in taxes, but now get that money back that you did pay in taxes, so that's for you and your family or your favorite charity. And some people joke like, "Oh yeah, I'm not going to get any advantage," but most of the families that we work with, they're thinking about, well, what about my kids and what about my grandkids, And that's just another way. If someone were to ask me, hey, what would you do? Would you do a Roth conversion or do life insurance? My answer is always the same. I'm going to look at life insurance as my first option. And like you said, Tyson, some people they can't qualify because health or whatever, but I want to maximize every nickel that I'm getting back. And the life insurance is always going to be my first choice if someone's there and it makes sense in their financial situation. And then the other thing is then I'll go to Roth. And so many people
Yeah.
do that wrong is they go to Roth and Tyson, let me just tell you one pitfall that we see all the time. You mentioned, hey, even a Roth conversion, it sounds simple in concept, but it's not.
Exactly.
One of the biggest mistakes that we see people make is they're like, oh, this is simple. I can just do this myself. I'm just going to cash out. I'm just going to cash out my IRA and put it in my checking account and then go over to a Roth. Well, that one move by putting it in the wrong bucket just screwed up the whole Roth conversion. You've got to be able to know what you're doing when you do it right because a Roth IRA contribution limit is $7,000 in 2025. And if you're over 50, it's $8,000. If you went to your bank account, moved it all over to your bank account and you missed the deadlines, all you can get now is 8,000 of that back over where if you converted the full 294 and you do it in the right way, you can literally get that over into a Roth. So Tyson, these are just some of our favorite strategies. And they're so unique and individualized to each person that you need, this is not a do-it-yourself project. This is something that you ought to have some professional guidance on and some help to make it happen because you get to do this one time. We do it thousands and thousands of times for families.
And one other thing I want to mention, Ryan, is required minimum distributions.
Mm-hmm.
The reality is when we talk about Roth conversions, Roth ladders, mega Roth backdoors, all of that is saying we want to get rid of required minimum distributions. We don't even want to have you pay required minimum distributions because if we get it all over into a Roth or into a life insurance policy and pay the taxes up front, then that growth happens in a tax deferred environment, and then when you pull the income out, it happens in a tax free environment with the way that we've set it up. But let's talk for a second about somebody who is already past this point and they're already paying required minimum distributions. It used to be this is another policy that's been changing year by year. It went all the way from 70 and a half to then 71, then 72. Currently, it's at 73 years old that you'd have to start taking required minimum distributions. Let's say you're already taking required minimum distributions and you're concerned because, hey, I think I'm too old for life insurance. I think I'm past the point where I could do a backdoor Roth or something like that. Well, we're always going to look at it regardless, but there are still some things to help you to reduce your taxes in retirement. One of those is what we call a QCD, a qualified charitable distribution. And what this allows is for you to donate money to a charity of your choice, from your IRA, from your 401k, to satisfy your required minimum distribution without increasing your taxable income. And so the amazing thing about it is literally you can say, I want to do $20,000 to this charity, and that gets pulled right off the top. So it's actually better than just a deduction because you get to take that right off the top of your income. And we have helped thousands of people to do a QCD as well that could make a huge difference, even if you're not in a time of life where you could be doing a Roth conversion or a life insurance policy. So that's another way that we love to be able to help people. And the great thing is we can do this at the beginning of the year, the middle of the year, the end of the year. A lot of times people wait till the end of the year to do this. And we say, let's get this done right now so that you don't even have to worry about it and you can actually get your taxes done early. So that's another one of these fun things that we get to share with people if they are like, well, I'm kind of past the age of doing all this. I'm already doing required minimum distributions. I think I just have to pay what I have to pay. There's still ways. We're always going to be looking out for you first and make sure that we can do whatever we can to help you.
Yeah, Tyson, let's just kind of put a bow on this. We've talked about some important principles here. First of all, there are things you can do about your tax scenario. You have more control over how much you pay in taxes in retirement than in any other time of your life during retirement. Okay, so that's principle number one. Number two is when you look at the advanced strategies like a Roth conversion or a conversion from an IRA or 401k over into life insurance, and then consider your RMDs. These are all powerful ways that you can reduce your taxes. I sometimes people hear. So in fact, we were at a conference and they're like, "Hey, why are you guys talking so much about minimizing taxes? We want to pay our taxes." And we're like, "Well, yeah, we want to pay our fair share of taxes, but we don't need to give Uncle Sam a tip, right?"
Right.
And so, like in the example of Bob and Carol, their total tax bill was getting close to $1 million. Well, we were able to reduce that tax bill down to 311,000. So $641,000 difference. Imagine what that can do. So many people are worried about inflation. So many people are worried right now about how they're going to help their kids and grandkids get into a house. These are areas that by smart planning, you can put to work for you. And, so these are just fun things to talk about. Tyson, we're passionate about this, helping people retire with confidence. The tax piece is probably one of the biggest needle movers that they can do in retirement, right?
It is. And here's what's fun about it is that's just one piece that we get to do. It's definitely the biggest needle mover. But at B.O.S., we create personalized retirement blueprints, a plan that not only addresses the taxes, but it addresses income needs, growth strategies, passing on a legacy, all of these areas in addition to taxes, so you can truly thrive, not just survive all through your retirement years. So when you're ready to take control of all of these pieces, we want to help you to make sure that you're doing all of it. That's what's so fun. That's why we're so passionate about this, is because we really truly get to make a difference in people's lives in ways that they can't imagine otherwise. And so remember this, retiring successfully today, it doesn't happen by accident. It starts with the B.O.S. Retirement Blueprint, and that plan is going to change your retirement years from now until the end of your life.
Thanks for listening to the Retirement Solutions Podcast with Tyson Thacker and Ryan Thacker. If today's episode inspired you to plan for retirement, go to bossretirement.com/podcast to receive a complimentary B.O.S. Retirement Blueprint. We'll be back in 2 weeks with another story to help you retire with confidence. B.O.S. Retirement Solutions is an independent financial services firm helping individuals create retirement strategies using a variety of investment and insurance products to custom suit their needs and objectives. Investment advisory services are offered by duly registered individuals through B.O.S. Retirement Advisors, B.O.S., an SEC-registered investment advisory firm. The information contained in this podcast is given for informational purposes only, and no statement contained herein shall constitute tax, legal, or investment advice. The information is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. You should seek advice on legal and tax questions from an independent attorney or tax advisor. Our firm is not affiliated with the U.S. government or any governmental agency.